Hello everyone. Welcome to R&A Knowledge Series 2026. My name is Sandeep and I will be moderating today's session. So as many of you are already aware that R&A is celebrating 30 years this year, and as a part of the milestone, we have planned some series of this topics. So today's session is our third webinar and the topic is foreign investment, FEMA and FEMA compliances. So earlier we have circulated a Google form, and our team has also revisited the relevant rules and regulations of this FEMA and identified certain areas which require a discussion. So the questions has been curated in such a way so that we will discuss this today and address most of the queries related to all this master directions and rules. So before moving forward, a general instructions to everyone. Request everyone to kindly keep your microphones on mute and while the experts are speaking. And if you have any questions, you can type it in the chat box. And if you want, or you can make a note of it, and you can use during you can raise these questions during the Q&A sessions once the session segment with respect to the expert is completed. Moving further, today our experts are Ms. Rashida Adenwala and Mr. Prashant Jain. Welcome, sir. Welcome, ma'am.
Thanks, Sandeep.
Yeah.
Thank you.
So before even starting the process, this segment, I have a basic. I want to set this topic in a very basic question. Like before I hand it over to the experts, I would like to begin with a very basic question. So many professionals here may already be familiar with FEMA regulations. However, this question is particularly for the young professionals or those who have yet the opportunity to deal with the FEMA. So if you see under the Companies Act, there are sections, rules, and modifications, whatever exemptions are there, they're all on the same place. However, when you come to FEMA, there are FEMA Act, there is Master Direction, then there are rules, regulations, and top of it there is again authorized dealer practices and all. So my question is there is any methodology, a structured way of methodology to read and interpret the FEMA regulations effectively? Because in my initial years of practice, I found FEMA a bit difficult, and I felt that the regulations are all scattered and all because you have to go through the different provisions. So my question to Prashant sir is there is any structured way or methodology to read and interpret FEMA regulations effectively?
Sandeep, there are three important aspects basically before I answer your question. Now, see, any regulation or a law will have set of regulations, set of rules, and then maybe the master directions. Specifically under FEMA, you have a master direction. So I will just give you a clarity on how a master direction works, and then maybe I'll work backwards to make you understand how a master direction is curated and what is the significance of master directions, as that it will give you it will give everyone an insight into what could be the potential regulations which anybody should go through once they specifically want to find an answer for a query. So under FEMA, the Master Act is Foreign Exchange Management Act, which everybody knows. So that's the act under which the regulations or rules are framed. And there are two important segments of documents which RBI releases every year. One is the FAQs on a particular subject. So if it's a foreign direct investment, so you will get an FAQ on FDI. If it's a ECB, then you get a FAQ on ECB. If it's an ODI, then you get an FAQ on ODI, and so on and so forth. So you will have a bunch of FAQs, which basically will give you insight into the frequently asked questions. So that is not a law, but which is also not binding. So it may so happen that the FAQ could eventually be conflicting with the regulations or rules. Ultimately, the rules and regulations will prevail. That, as company secretaries, everybody is aware. But yeah, FAQs are the documents which basically give you a ready reckoner kind of answers. So that is one important aspect. If anybody wants to find ready reckoner kind of answers, they can go through the FAQs. Then the other document is the master direction. So master direction is nothing but the consolidated what do you call document which gives you the rules regulations at one place. So if you see the foreign direct investment law today, you will have regulations towards it, you will have rules towards it, you will have certain other ancillary annexure schedules. But if somebody wants to find an answer to an FDI question, then he can basically go to the master direction, review the master directions, and then he could find an answer for it. But ultimately, if somebody wants to understand why a specific question has been basically answered in a particular way, then they have to go to the Foreign Exchange Management Act. Then your specific regulations for which you want to find an answer for, corresponding rules, and then you will have a master direction which is consolidating all the rules and regulations. So for young what do you call professionals, I will advise that they should always go through the Foreign Exchange Management Act, which is FEMA, to basically understand the basic principle on how a regulation and rule is framed. And then maybe they should go to the specific regulation. If they want to get an answer for FDI, they can go to the non-debt issue regulations. If they want to find an answer for ODI regulations, for ODI, then they should go to the ODI regulations. But if they want to find consolidated answer for everything, they can go to the master directions. Under master directions, the important thing which you need to make sure that is that the master direction is on a specific date. So RBI releases a master direction on a specific date. For example, if they have released a master direction today, so it will be updated till today. And if there are any amendments post that, then those will get reflected in the regulations. So cutoff date is important when you're going through the master directions. And after that, you have to go to the specific regulations and review it.
So I also believe that first we need to understand the transaction. Then based on the transaction, you go to the relevant rules and regulations.
Absolutely. So if it's an FDI transaction, then you go to the FDI regulation. If it's an ODI transaction, you go through the ODI regulations. If it's an ECB, then you go to the ECB. So there are a bunch of regulations, but generally for company secretaries, ODI, FDI, and ECB are more relevant. Import, export, guarantee regulations, deposit regulations are also relevant, but maybe not so much as compared to FDI, ODI, and ECB. And for all these, you will have a master direction specifically issued by RBI.
Understood, sir. Ma'am, you want to add anything, or shall I move to the next segment of questions? Yeah, we'll move
Yeah.
forward. Yeah.
So as rightly said, I mean, obviously, whenever any query is there or anything, while you have the master direction which gives you a consolidated thing, but if you have to get into the depth of it, you have to, of course, understand the regulations. So you'll have to read through that. And FAQs are helpful, definitely helpful to clear any kind of, your doubts you have. It definitely helps you to clarify that.
Also, one more thing, in case of any specific doubts, it's always better to send a mail to FEMA department in advance and get a clarity and move forward. What do you say, sir?
Now, see, that is always there, but you don't expect the regulator to answer all your questions, right? So
Right.
regulator also expects that, if you're writing as a professional, you have done your homework and then you're writing. Because generally what happens is whenever you go to a regulator, the regulator will always tell you to come through the authorized dealer. They will not give you answers directly.
Right.
So there is a lot of hassle. But if there are any specific questions which are very complicated, which are not answered directly through the master directions, regulations, rules, then maybe you should approach the RBI. And the proper way of approaching RBI is through the authorized dealer. So nowadays RBI has also launched a Pravaha portal. So if you have a specific query, then you can approach your AD. AD will do their scrutiny basis their recommendation or basis their inputs. The document will get uploaded on Pravaha portal and then it will go to RBI. So maybe anything which is ambiguous under law, definitely you should go to RBI through the AD and get an answer. But for every small queries, I don't think RBI will entertain.
Understood, sir. So I'll move to the next segment, sir, with respect to the questions. So the first question is with respect to convertible securities. The question is like an Indian company issues the CCDs to a foreign investor through a private placement. Under the Companies Act, pricing can be determined either upfront or at the time of the conversion. However, while filing Form FCGPR, a valuation report is mandatory. So the query is, since valuation is mandatory at the time of filing FCGPR, can we say that Rule 13 of the company's share capital debenture rule does become inapplicable in the case of a foreign investor?
So there are two laws, right, in your question. One is because it's a foreign investment, then it basically means FEMA will come into play. And because it's a company, and if you're doing a private placement, you have to follow the Companies Act, right? So from FEMA perspective, the law is very clear. Whenever you're issuing shares to a non-resident, right? When you're issuing a convertible instrument, the pricing formulae or the conversion ratio has to be fixed upfront. So that eventually means if you are issuing a compulsory convertible debenture to a foreign company or a person resident outside India under FEMA, then either you say what is the conversion ratio, which could be 1:1, 1:2, 1:3. That depends upon the issue price. For example, if you are issuing a compulsory convertible debenture to a non-resident today at say 50 rupees, okay, uh, the face value could be 10 rupees. You are issuing at 50 rupees, and RBI, and because it's a non-resident, you have to take the certificate from a chartered accountant or a merchant banker or a registered valuer as given under FEMA on the day when you issue the instrument. So, for example, I have issued the shares at 50 rupees of 10 rupees face value, and I am getting a certificate from a chartered accountant today, which says that my fair value is 50 rupees. Okay. So, your fair value is frozen today. Your certificate is frozen today, and you have to file the certificate with RBI. Whenever this instrument gets converted, you have to ensure that the conversion price should not go below 50. So
Right.
here in my example, the conversion price would, if it is 1:1, absolutely fine, but it cannot be 1:2. If it is 1:2, then the effective price becomes 25, right? And the valuation at which you have, the fair value at which the investor has entered is 50 rupees because you have taken the certificate upfront. So under FEMA, the certificate has to be taken upfront. The fair valuation has to be done upfront. At the time of conversion, you have to ensure that the conversion price doesn't go below the fair value. That's under FEMA. Now, in the same example, when it comes to Companies Act, if it would have been a domestic investor, not a non-resident investor, then it's up to you. You want to take it at the time of conversion, you can take it at the time of conversion. But the only catch here is whenever you take at the time of conversion, you have to ensure that the conversion price at which effectively the convertible instrument is getting converted is not below the fair value on the day when you have taken the certificate. So in your question, if a domestic investor enters today at 50 rupees and you have taken a certificate today, at today only upfront you have taken, and you have taken the fair value as 50, your
Right.
fair value is lot. So whenever he converts, he cannot convert below 50. But
Right.
if you, in the terms of issue, you say that I will take the certificate
At
maybe
the
at the
time of
time of
conversion.
conversion, then if the time of conversion, if the value is 70, then it cannot go below 70.
Right.
So that's the catch. Under Companies Act, it's up to you. Whenever you want to take, you please take. But at the time of taking the certificate, you have to ensure that at the time of conversion, that price doesn't go below the fair value. Under FEMA, it is pretty clear. Upfront, you have to take and you have to ensure on that day itself that the conversion is in line with the fair value at which they are entering today. So that's the interplay between the FEMA and Companies Act.
Understood, sir. An extended question with respect to this matter only. So FCGPR we need to file within 30 days from the receipt of money or the allotment, right? So in this case, I have filed the FCGPR at the time of the issuance of CCD. Later, at the time of the conversion of the equity shares, fresh allotment happens, right? So at that time, do I need to file an FCGPR? And if I
Now, see,
don't file, would it be amount to violation of the FEMA because the FEMA says that you need to file the FCGPR within 30 days from the date of allotment?
no, FCGPR gets filed only at the time of allotment. At the time of conversion, you don't need to file FCGPR. The only administrative action which you need to do is you have to get your entity master form updated with RBI. So after you have converted the convertible instrument, there is a annexure given by RBI. That annexure has to be filled. You have to give a reason why they have to update the entity master form. In the reason, you have to write that the convertible instrument which you have previously issued has now got converted, and these are the number of shares which you have issued. That has to be filled along with all the relevant resolutions. So if you have converted a specific instrument, then you will pass certain board resolutions. Those board resolutions have to be annexed to the form. That form has to go to RBI. Within 15 days, RBI will update your EMF. And this administrative action is not written under law. It is something which is required, because what happens is after you have converted the CCD, if you have not updated this in the EMF form with RBI,
Right.
in future, whenever you do a fresh allotment to a non-resident,
Hmm.
that time you will be reporting your percentage of FDI.
Right.
So there will be a mismatch. So when
Mismatch.
there is a mismatch, then RBI will not approve your that FCGPR until this is updated. So the moment you convert, you have to administratively file this form and get it updated so that going forward it doesn't impact you in any other allotment. It's not a what do you call non-compliance if you don't do it, but practically this has to happen. Otherwise, that will become a bottleneck when you do a further FCGPR or FCTRS filing going forward.
This is not a directions, na, sir, from RBI. It's a general practice which has been followed.
Yeah, and it's important because we have seen cases where we have not done it, and later on when we are doing other corporate actions, the other corporate actions are getting stuck until this is updated.
Mismatch. Okay. What is the process of reporting, sir? Through mail, we will send it to them, or how
No, see Pravaha portal. So
okay.
you download that annexure. There is an annexure for updation of MTT master form. You fill that entity master form, and then along with that you attach all the relevant documents in Pravaha portal. You upload it, and it will directly go to RBI. Within 15 days, they will come back if they have any queries. Otherwise, they'll update your EMF.
Understood, sir. We'll move forward to the second question. The second question is with respect to NRI shareholding on a non-repartition basis. So the question is: an NRI invest in an NRI invest in an Indian company and declares that the same is on a non-repartition basis. The query is: does the investment done by the NRI requires FEMA compliances?
No, see, FEMA compliance is a larger word. FEMA, it requires FEMA compliances. Whether it requires reporting under the FCGPR, I think that's more relevant. So if you are doing a non-resident Indian investment under non-repatriation basis, then no FCGPR is required. But if you see the regulations, there are other conditions. FEMA will apply. It says that the shares have to be non-repatriable. Second, it says that whenever you sell the shares, the proceeds of the credit of the shares shall go into the NRO account. So technically FEMA is applicable, but the reporting requirement or FCGPR doesn't apply if it is on a non-repatriation basis. And you need to satisfy the definition of NRI. So NRI under FEMA would mean any person who is holding OCI or a PIO card. Then only they will be an NRI. As long as they are NRIs, they can do the investment under non-repatriation basis. One, they need not file FCGPR. Second, the proceeds at the time of sale have to be credited into the NRO account. Those cannot be repatriated. So that's the answer to the query.
So I also understand that with respect to the non-repatriation, it is not been documented anywhere. Means you don't report specifically to the bankers or specific. So it's a self-declaration kind of thing. Where how will you say that this is on non-repatriation basis?
No. One is the money will come from NRO or NRE account. That is important, right?
Right.
So if it's coming from NRO, there is no choice. It will
Very
be
clear.
always non-repatriable.
Clear.
Okay. So if it's nothing but a non-resident ordinary rupee account, so it is non-repatriable. For NRE credits, you have to specifically choose that the shares will be under non-repatriation if you are doing it from NRE account. There, what we do is, one, we capture that in the board resolution when we are issuing the shares, that these shares will be non-repatriable. And if the shares are issued in physical form, then on the sales certificate also we write that these shares are issued on non-repatriation basis. Third, if these are credited in demat account, then anyhow the demat account also has to be NRO ordinary rupee demat account. It cannot be NRE ordinary rupee NRE demat account. For demat also you have separate demat accounts, so it has to be NRO demat account. Otherwise, again, it's a violation.
So demat is like repatriation demat account and non-repatriation.
Yes, specifically you have to open if you don't have as an NRI.
Understood. So an extended question of this query, sir. Suppose the same NRI in its second tranche of the investment send the funds from this NRE account and declares that it has a repatriation basis. Can he do so? So initially he had done in a non-repatriation basis, and the second tranche is repatriation basis. Can he do so?
So FEMA doesn't take away your right just because you have done one investment under repatriation, another you want to do it on non-repatriation. It will always be your choice. As long as you are qualifying the definition of being an NRI, as long as you are declaring that it will be on a non-repatriation basis, and as long as you are following the non-repatriation conditions, you can choose. One investment could be on repatriation, the other investment could be on non-repatriation. Absolutely fine.
I think, Rashida madam, you want to add some because you are dealing with specific query, right? But there are some conditions, it seems.
So here, what happens is that while what Prashant said was very clear that if it is from NRO account, definitely it is non-repatriation because it has come from an NRO non-resident account, which is an INR. When it comes from NRE account, obviously you have to have, if it's demat, definitely two distinctive demat accounts. Wherein one is very clearly it is demarcated as non-repatriation demat account, and the other one will be from a repatriation demat account. But if it is in physical form, and if initially if it has come from the NRE account, your money has come from NRE account, but you have declared it as non-repatriation, but not have as demarcated or not really given or quantified that this will be non-repatriation. You have assumed it to be non-repatriation. So you have not even done any filings. You have not done any reporting to the authorities. Then in such an event, if a second comes, and if that comes in US dollars from an NRE account, or if it comes in dollars, and if it has come in, then in that case, the first one cannot be considered on non-repatriation basis. That also will have to be part of repatriation basis. And this is what we have encountered, and in one of our cases now, which we, and they have very clearly, RBI has rejected that, saying that you first file the first FCGPR. After that, only we will approve the second FCGPR. So that has not been approved. And very clearly, they have said that one cannot be on repatriation, the other cannot be on non-repatriation basis, because there's no distinction as such which has been made.
So if I reframe this question, in case in the first issue, if it is on a physical share, if your share certificate mentions that this is on a non-repatriation basis which has been documented, then in that case, RBI should not question the first tranche.
But then I think there has to be some reporting about that, which has to happen.
See, madam, what I have seen is if it is coming from NRE account, right, the ED banker will report to RBI. They have a consolidated monthly or bi-monthly or a half-yearly reporting where they report this to RBI saying that this money has gone for this purpose on a non-repatriation basis. If you have not declared this to the AD saying that I have invested on a non-repatriation basis, then it's a problem.
Yes, that's the problem. They have not reported to the AD that it is a non-repatriation.
So, Sandeep, to answer this question, when the debit is happening from the NRE bank account, that debit, you have to declare to the AD saying that I am investing this money into the Indian company on a non-repatriation basis. And that reporting he will do to RBI. Because for him, it's a foreign currency account. And for all foreign currency is accountable to RBI. He has to write he has to give, they have some internal reporting. They will report. But you have not done that suddenly just because you wanted to say that it's non-repatriation. If you say, they will not agree. They will say, no, it's only afterthought. Because you have not done the reporting, it's a violation. So that NRE is a foreign currency account. So that debit happening, purpose of debit has to be clearly declared.
Understood. So the answer to this question is, yes, you can do it. But the thing is that you need to declare. In both
at the time of debit itself, you have to declare.
Yes. Moving on to the second question, same with respect to NRI only. An NRI individual is holding shares in an Indian company on a non-repatriation basis. Subsequently, non-resident individual has got US citizenship. After 2 years of acquiring the US citizenship, the non-resident individual has gifted the shares to his brother, who is a resident of India. So the question is, can the non-resident individual continue to hold the shares on a non-repatriation basis after becoming a foreign national? The first question.
No, absolutely. See, whether he's a citizen, whether he's not a citizen, doesn't matter under the FEMA Act. As long as he's qualifying the definition of an NRI, he can hold the shares on non-repatriation. Absolutely fine. Just because he is now holding US citizenship doesn't change any of the benefits or any of the rights which he has under FEMA. As long as he's an NRI, he can hold the shares on non-repatriation basis.
Okay. So again, he has gifted it to his brother, who is a resident of India. So the question is FCTRS required to be filed for the transfer of such shares as a gift?
No, because the shares are because the shares are under non-repatriation basis, it is treated as domestic transfer. So it's a resident to resident transfer. No FCTRS is required.
Understood.
I think there's one question from on the chat.
We will take the questions in the last Q&A.
If it is relevant to this one, then maybe we can finish it here.
Question 2. In case of CCDs issue 2, for the transaction which there is no foreign exchange happened and no FIRC is being issued, then how to report FCGPR?
No, see, FCGPR is reported when there is a inward remittance, either in the form of foreign currency or in the form of INR. FCGPR has to be filed as long as it is coming on a repatriation basis from non-resident or a non-resident Indian. Now, FIRC copy has to be issued. If the FIRC copy is not issued, we need to know why exactly FIRC copy is not being issued. And
No, no,
generally what happens is there are two things. One, what happens is if I am a non-resident holder, if I want to send money, I can directly send money to the beneficiary's AD in foreign currency, or I can send the foreign currency through my converting bank in India to the ultimate beneficiary. So, for example, if there is a company in India, they may get the credit in INR. That eventually means they got money in INR, but there is a converting bank in between. So,
right.
the FIRC copy will be issued by the converting bank. So, you have to basically go to your AD, ask him who has converted this money, and ask them or the remitter to coordinate with the converting bank and get you the FIRC. But just because you have got in INR doesn't mean that you will not file FCGPR. FIRC copy will be issued either by your AD if they have received the foreign currency, or by the converting bank in between. So you have to identify which is the converting bank and file the FCGPR. But a lot of times people don't know. They think, okay, money has come in INR, so maybe I need not file FCGPR. No, FCGPR has to be filed. The FIRC copy has to be issued by your AD if he is receiving the foreign currency, or by the converting bank in between.
Understood. I think the question has been addressed. We'll move on to the next question. This is related to bonus shares. An Indian company has issued CCPS to foreign investors. The company now proposes to issue bonus shares to its equity shareholders. So, since CCPS will ultimately convert into equity, a question arises regarding the bonus entitlement of CCPS holders. The question is, should the company issue bonus shares upfront to CCPS holders based on the conversion ratio, or should the bonus entitlement be adjusted and issued only at the time of the conversion of the equity into equity?
So Sandeep, there are two things here. One, ultimately, if the company believes that they want to issue the bonus shares to the CCPS holders on day one, they can absolutely do it. There's no restriction. But we have seen investors, specifically from tax havens like Mauritius, Singapore, they basically wanting to have the grandfathering benefit. So there, what happens is if there is an additional instrument which gets issued, either in the form of bonus or any other form, they lose the benefit of grandfathering. So if, for example, if somebody has entered in 2000 before 2017 from Mauritius, anything which changes their color, okay, after 2017, there is no tax benefit for Mauritius investors. So before 2017, whoever has invested, they continue to have tax benefit. Now, after 2017, if there is a bonus issuance, we have seen Mauritius investors saying, don't give me any other equity because my original shares get stripped. So they say that I will take the additional shares through the conversion ratio. Right. So those kind of investors. So one, the answer to answer your question here is you can do it both ways. The regulation doesn't basically give you preference. It says it's up to you. The
Okay.
ultimate point here is the percentage of holding should not change. When you're doing an equal bonus to everyone, the percentage will not change. That has to be taken care. The only thing here is if there are investors who want to basically not take additional shares but get the shares through the conversion ratio, that is also fine. But of late, what we have seen is after you convert, you will, as I said, you have to get the EMF updated with RBI.
Right.
At the time of EMF updation, if I tell what happens if you issue them, if for example, if you issue bonus shares to a non-resident, you have to file FCGPR form. You will file it. But if you have not given shares to the non-resident, but you have said that it will get converted at the time of
Conversion.
conversion, you have not filed FCGPR. So the moment you go for EMF updation, RBI will ask you, you have given bonus, you will say yes. They will say, where is the FCGPR? Then you will tell them, I have not given bonus shares directly, I have given them through conversion. So of late, we have seen RBI is not understanding. They are saying how you have given, show me the calculation, how can you do this? So what we have been telling that before you do, if you are issuing direct bonus, no problem. Issue the share, report in FCGPR, all done. But if you want to give differential treatment by saying that you will do it, you will do the adjustment at the time of conversion, then if you have time, this is again a what do you call a suggestion. You want to do it through conversion, absolutely fine under law. But from an administrative perspective, we are telling our clients that before doing, write to RBI saying that I am issuing bonus shares. For residents, I will directly give equity. For non-resident, I will adjust in the conversion formula. Send it to them in Prabhava portal within 2 weeks, 3 weeks, they will reply. Then do it. So that at the time of conversion, when you are getting the EMF updated, this letter can be attached saying that we have asked you and you have given this reply. So we tell our clients, if you have time, write to them, take approval and do it. But technically under FEMA, as long as the percentage of holding is not changing, whether you issue direct bonus shares or you adjust in the conversion ratio, both are fine. But from RBI's perspective, to keep things smooth, I will always tell my client, was go, write to them, take approval, keep in your file. And they'll give it within 2-3 weeks, they generally give it.
So we have to take the precaution by writing them, means by intimating them in advance.
Yeah, and
But
previously,
one more very basic question, sir. Since CCPS holders has not been converted, before the conversion, before they become an equity shareholder, can you issue bonus of an equity to them?
absolutely. See, if you see their terms of issue, whenever you issue
Yeah.
a instrument to
Hmm.
any equity holder in the company, CCPS terms of issue will say that my conversion ratio shall be adjusted for any split or bonus. See, end of the day, instrument doesn't matter. The percentage of equity. If I'm holding 10% of the company today, just
Hmm.
because somebody has got bonus, my 10 cannot go to 9, na? It has
Right.
to be adjusted to 10.
Right.
So either I get additional shares now or I get it at the time of conversion. So percentage of equity matters. And in the terms of issues, also it is written generally.
Understood, sir. Anything in the same query, anything with respect to the pricing guidelines, reporting, and any terms
No,
with
see,
respect to the pricing?
bonus, whenever you do a bonus issuance to a non-resident,
Hmm.
if you are doing direct issuance, then you have to file FCGPR. At the
Right.
time of filing FCGPR, what happens is two things we have seen. One, they will ask you all prior reportings which you have done because they have to map it. If I have been issued one share for one share, my previous one share was reported or not. Those
Right.
FCGPRs have to be, though proofs of those filings have to be given to RBI. Second, what I have seen previously is if for any reason I delay the filing of FCGPR for bonus issuance, then there is a LSF which is applicable, late filing fee.
Right.
How do they compute late filing fee? The share is a free share.
Right.
So you assume that it's a free share, and if you see the LSF table
On
of
the value.
penalty, it is on the value. So
Right.
how do you take value? So we have seen in none of our case where we have done the bonus reporting after 30 days or 60 days, whatever is applicable under law, they have taken the original investment as the investment for the bonus shares. On
Okay.
that they have applied.
Okay.
So that Excel also has to be given. So in bonus shares, sometimes what happens is I have done a bonus issuance for a shareholder, the non-resident shareholders who invested 800 crores. Now,
Right.
if I delay one day, my penalty is computed on 800 crores, which is original cost of acquisition. So
Hmm.
for bonus, if you delay FCGPR filing, the penalties could be huge.
Right.
Because if the investment value was high, then that is taken as the benchmarking for computing the LSF. So that is one advice which we tell our clients and the colleagues who are there on the call, that LSF could be very, very high in case of a bonus.
Should be careful before issuing bonus share, before reporting.
No, ensure that the reporting is happening on time and you
Thanks.
understand when to report.
Yeah.
So by not issuing or by doing this conversion, I mean, saying that since the shares are not issued itself, it's going to be adjusted at time of conversion. This particular point becomes very relevant that it has to be reported at least in the form of a letter and informed to RBI that yes, this issuance has happened, but the shares will effectively come into existence only at the time of conversion.
Okay. We'll move on to the next question. The question
Yeah,
is with
before we
respect.
move on, there's
Yeah.
one point which I wanted to talk about in
Yes.
for the first query that we raised about the pricing part
Conversion.
of conversion, right?
Hmm.
So when we talked about the conversion and we spoke that, okay, as rightly said, that we have to have the price which is determined right from, especially when we are
Upfront.
giving it to foreign shareholders, the price has to be because the value cannot be less than the value. But the question then there is many times we see that for startups, and especially, there are foreign shareholders which come with a kind of saying that there's a base value, right? And the conversion can happen at a, higher, I mean, in case at the time of conversion, if the value is higher, right? Then they can get converted at that price, right? So what is relevant here is that if you're converting at a higher price, at a higher value, that is fine, right? But it cannot be converted at less than the base
Less than
price.
the
So
base.
that's why you find that there's a base price which is fixed. But in case if after 2 years or 3 years, you have a conversion which says that, okay, it will be converted at 10% or 20% discounted to the fair value then, but still it is higher than the base price. It is fine. It is fair. You can convert it. And obviously, there is no further FCGPR required. It happens there, but you just have to update it with the number of shares that it has got converted into. Prashant, am I right on this?
Absolutely. If there's a foreign investor involved, there has to be a floor. And that floor
Yes,
cannot be below the fair value at which they have entered. So
correct.
in many of the startup deals where VC or private equity guys are investing, there is always a floor. And if there is no floor, then automatically the fair value becomes the floor. They cannot go below that. So
Correct.
that language we generally write that the price at which this will get converted, for example, if it will get converted 25% to the pre-money valuation of the next round, we write that 25% to the pre-money valuation of next round subject to a floor of X. And that floor cannot be below the fair value if it's a non-resident investor.
So this particular clause, we will you ensure that you enter in the agreement, shareholders
You have to
agreement.
write because what happens is when you file FCGPR, that time they'll ask you for a conversion ratio. And if you say that, okay, I have a formula, but there is no floor, then it's a violation. Because there has to be a floor. That floor cannot be below the fair value. And that valuation report will be the fair value at which any investor is entering. And that language has to be there.
So the conversion, so the whole thing is important is that either you fix the conversion ratio there, or you give a formula. Either of the them at the time of the first, when you're filing the FCGPR. So when you're filing the FCGPR, you have to either give the conversion ratio, if there's 1:1, 2:1, whatever it is, as long as, and there is a fixed. If there is no conversion ratio, then there's a formula attached to it. You have to give the formula, which says like, okay, whatever be my next round of funding, 25% discount to that, that becomes your formula, right? So then you have to file with that.
Understood. Moving on to the next question. This question is with respect to startups. So, Prashant sir, we want you to throw a light on what are some relaxations and exemptions on startup companies. Like they have instruments, like the separate instruments, like convertible note, anything related to their tenure and repricing compliances, any relaxation on the startups.
See, from a FEMA perspective, the only additional instrument which comes into play is a convertible note. So if you see the FDI regulations, any instrument which is compulsory convertible into equity comes under FDI. Anything which is non-convertible or optionally convertible goes under the ECB regulations, right? But for startup, RBI and under company law also, there is an exemption which says that if you're raising money from a non-resident, and that should not be below 25 lakhs. So convertible note has to have a minimum value of 25 lakhs. Then you can have a hybrid instrument. Convertible note is nothing but a hybrid instrument where you can either convert the convertible instrument into equity on a future date at a specific valuation, or if the investor or you agree upfront that this will get repaid, right? Based on the terms of issue, the convertible note can also get repaid. So that is an additional instrument which comes into play for startup without breaching the ECB regulations. That is under FEMA. Under Company Act also you have convertible note, same definition. There, if it's a convertible note, it will not trigger the deposit regulations. Because if you see the Companies Act, any money which you take from a certain set of people, other than certain set of people, those will qualify as a deposit. But if it's a convertible note for a startup, then that is one exemption which you get. Off topic, under Companies Act, if you are a promoter, generally you are not eligible for ESOP. But if you are a promoter of a startup, then you are eligible for an ESOP. These are the 2-3 important benefits which you get under FEMA and Companies Act if you are a startup. Under tax law, again, it's different, right? Tax though, it's all different. So you get tax holidays and also, yeah. So that's
Yeah, but the startup, important thing, remember that it has to be registered with DPI, I mean the
DPIT.
startup registration, and also you have to have that certificate. So, but just by registration is not enough. You have to be qualified as a startup. So that is very important. And
Yeah,
it's
so
not
only registering with DPIT doesn't work. If you want to,
yes,
DPIT will work for FEMA and Companies Act. But under tax laws, if you want benefit, then there are specific exemptions which are available for startup. Like previously, now it's not relevant, but previously there was the angel tax. So you had to go and register as a startup if you wanted exemption under angel tax. Then there are other exemptions under tax. So you have to file that DPIT certificate, be eligible for tax benefits, get that certificate, then only you are eligible for tax benefit.
So move on to the next question. This is with respect to cross-border mergers. So in case of a merger of a foreign company into an Indian company or a vice versa, what are the FEMA approvals apart from the Companies Act it is required? What is the process of getting the approvals from them?
See, my understanding goes that there are no approvals when it's an inbound merger. If it's an inbound merger, then technically means that there are certain assets and liabilities which are getting merged into an Indian company, right? So
Right.
there for the merger, if you're issuing shares as part of the consideration, then whatever reporting is required, like in an inbound merger, you will need to file FCGPR. That filing has to be done. So whatever NCLT route approval or whatever we need to take, we need to take. When it's an outbound merger, then the ODI regulations will come into play. But there is no specific approvals which are required when it comes to M&A, whether it's an inbound or outbound merger. But these two regulations will be relevant, and the kind of assets and liabilities which are getting merged. If there is a loan for a company which is merging into India, post merger that loan will become the loan of the Indian company. So that typically will come under ECB, right? Because
Right.
the lender is sitting there. So
Hmm.
those kind of what do you call line items we need to see and see whether these will be eligible. If these are not eligible, then as part of the merger, those have to be knocked off. If not, then you have to go to RBI and take specific approval. Otherwise, it's a pure play vanilla merger. If it's inbound, file FCGPR for allotment of shares. If it is outbound, then ODI regulations. It cannot be whoever is getting shares, because if it's an outbound merger, that eventually means that the shareholders of the Indian company will get shares of the foreign company. So whatever is the OPI, ODI regulations, those have to be followed.
Sir, what in case if in case of an outbound merger, if the company has immovable property, uh, any any changes in the dynamics?
No,
Because
outbound merger, see, under FEMA, a non-resident cannot hold any immovable property. So that
right.
asset should be out of the merger. It cannot go and merge.
So that is prohibited.
Yeah.
We move on to the next question. This is related to ECBs and loans. One question is with respect to Chinese parent loan to wholly owned subsidiary. So if a Chinese company proposes to give a loan to its wholly owned subsidiary, considering the land border sharing restrictions, is prior approval from the government required under FEMA for the loan?
See, that prior cross-border land border conditions are only applicable for equity. For loan, there's no what do you call approval required, as long as it is within the ECB regulations, and as long as it is within the ECB framework. No specific approval is required just because they are from land bordering countries. Land bordering country restriction is only applicable for equity investment, not for ECBs.
Only for the ownership.
Yeah.
Yeah. One more question with respect to loan, an NRI director loan. So if an NRI director gives a loan to an Indian company, will that loan will be qualified as a ECB?
No, see, again, NRI is giving from abroad through his foreign currency account, or he is giving from India through his NRO or NRE account. That becomes important. If a
Right.
non-resident Indian is sending that money from abroad, then definitely you have to test it for the ECB regulations. But if a non-resident Indian has the money in India in his NRO or NRE account, then under the FEMA deposit regulations, you have different conditions. So if he's giving from NRO account, there are conditions. Within those conditions, you can take the money. But if he is giving from NRE account, then there are other conditions. Within those conditions, you can take. These will not qualify as ECB because they are from Indian accounts, NRO, NRI. But if he's sending from abroad, then it is ECB. So being an NRI, you have these flexibilities where you can give it from Indian account, whether it's an NRO, NRI, and have a lenient, what do you call, or less compliance. But if you want to basically do it from abroad, then ECB regulations will come into play, and all the conditions under the ECB regulations have to be followed.
So
Yeah,
specifically
but then
for the
again, if it's an individual, then obviously, as far as Companies Act is concerned, It comes under deposits.
कंपनीज एक्ट तो separate testing है, वो तो देखना ही
No, no, but he's a
पड़ेगा.
director, no, ma'am. So if he's a director, then it will come
If
under
he's a
exempted
director,
deposit.
then it is fine. Yeah.
See, agar if it's coming from abroad, then your deposit regulation don't apply under company law, right? Because it's a foreign currency loan. So that way, maybe madam is saying, but if it is an Indian account, then Companies Act has to be seen. He has to be eligible under the Companies Act, and you have to follow the deposit regulation under company law also.
Then one more this thing, I think there's a query from, or there's a clarification from Sai that with respect to the previous thing, it says that if you have taken the loan, that is from the, I'm talking from the cross, sharing of the borders. Then if it's a loan and if it's getting converted into equity, then obviously you have to take the approval.
Absolutely. Anything which is convertible into equity, which gives ownership to the land border countries, entities or individuals, then definitely it has to be taken. But if it's a pure play loan, ECB regulations, then it's fine. Yeah.
So it's a prior approval from the central government. So it will go through same Prava portal.
No, it will not go through Prava portal. There is a different portal. There's a different department for this. It goes to the external home affairs.
Okay.
So you have to file an application. There's a checklist of documents which have to be submitted. They have a separate portal, MOE, Ministry of External Affairs. And from there you get the approval. It generally takes 6 months time. Prava is only for RBI.
Okay. Some question is there from Ravi. Says some NRI structured the transaction that he sends the money from his foreign account to his NRE account in India. Will that still qualify as ECB?
No, see, if you see in any bank account, NRE or NRO, there are certain permissible debits and permissible credits, right? If in the NRE, which I don't remember now, if in the NRE, what do you call bank account regulations, which you will easily find in RBI website, if the loan to a Indian company is a permissible debit, right?
Right.
Whether he wants to follow ECB or he wants to go under the FEMA deposit regulations, which I told you, right? If you are giving from NRE account, there are certain conditions. So to answer your specific question, if you see the NRE deposit regulations under FEMA, it specifically says that the money which a NRE wants to invest in a company as a loan, that has to be through a public scheme. It cannot be for a private scheme. For example, if a company floats advertisement saying that we are raising money, it could be an NBFC or whatever. If they are allowed to raise money from public, they will raise. In that, if you want to participate through NRE account, you can participate. So if it's public scheme, then that becomes relevant. But if it is not public, then you can't invest through NRI. Then whether that will qualify as ECB, you have to go and see the NRI permissible debit, where it says that you are allowed to give loan to the Indian company, and if it's a permissible debit, then you can declare that okay, it's a ECB and follow the ECB regulations.
Understood. So apart from the master directions, you need to see the deposit rules.
Master direction is nothing but consolidated document which gives you immediate access to all the information. But for all regulations, you will not find master direction. You will not find master directions, right? For FDI, ODI, ECB, you will find import export. You will find, but for deposit regulations, you will not find.
Not find. Yes.
You have to go and read the regulations.
Okay. Separate regulations. So, sir, is there any restrictions on the? Can an NRI give a interest-free loan, or any restrictions on the tenure?
No, see, FEMA is very simple. Anything which comes into India, it's okay if you give it for free. Anything which goes outside India, it has to be at a specific value. So in NRI giving at zero value, absolutely fine, no problem. But there FEMA will not prohibit you, companies that will not prohibit you. But from a tax perspective, the tax guys can come and basically take a benchmarking rate. For example, if you have given a interest-free loan to a company at zero interest, the tax guy can come on to the company and say that you have got an interest-free loan, the benchmarking rate is 10%. I will assume that you have got an income of 10% because you have not paid this, and I will charge you. So that's a different problem. But thumb rule here is anything which comes in, absolutely fine. Anything which goes out, then it has to be at a benchmarking price.
RBI guidelines. Indeed. Yeah. I think tenure is also there in the deposit rules. It cannot exceed 3 years.
Yes. 3 years it can't exist. So what are conditions? But yeah, at a high level, three routes are available, either NRE, NRO, or ECB, subject
Hmm.
to all the requirements under the specific regulations.
So there is one more account, sir, FCNR. So, what is that exactly?
That
Is
is
it applicable to
only, that's a
NRE or
FC, that is
NRI?
more for a non-residents. For example, if a foreign national comes into India and he wants to spend money in India, then he can open an FCNR account. That is not for NRI or non-residents. That's my understanding.
NRI can also open a FCNR account actually.
Maybe I'm not sure.
In
Maybe
foreign
he
country.
can open, but he will be treated as a non-resident only.
Right,
It
right,
is like he has come to India, he want to spend some money, he want to open FCNR account, absolutely fine. But from FCNR account, I don't think he will be able to make investments. That is more for a consumption purpose.
understood, sir. So we'll move on to the next question related to ESOPs. ESOPs issued by an Indian company to non-resident. An Indian company grants ESOP to employees of its foreign subsidiary or to the employees who are resident outside India. The question is, at the time of exercise of ESOPs by non-resident employees, are FEMA pricing guidelines applicable, or would the exercise price approved under the ESOP scheme be sufficient for the compliance?
No, see, I have to divide this question into two parts. One, the
Okay.
Indian company is issuing to the foreign employees. The other
Right.
is the foreign company issuing to the Indian employees.
Vice versa.
Okay.
Okay.
So for the first bucket of question where the Indian company is issuing to the foreign company
Hmm.
employees, no pricing guidelines apply. At the time of grant, whenever you grant shares to the foreign employees, you have to do a reporting on RBI's portal. The form is called as ESOP form. That time you have to file the ESOP form. That's point number one. Whenever they excise the shares, that uh, that reporting has to be done under the FCGPR because it's an allotment. The
Right.
only important point here is the price at which you are issuing has to be uniform for all employees. It cannot be special for foreign employees and it cannot be different for the Indian employees. As long as your uniform pricing is applicable to all the employees and you are doing the ESOP reporting, and at the time of allotment, do the FCGPI reporting. These are the three compliance which are important when it comes to Indian company issuing shares to the foreign employees. Now, in a vice versa situation where the foreign company, which is the holding company of the Indian company, is issuing shares, ESOPs to the Indian company employees.
Employees.
That time, at the time of grant, because the grant is happening at the foreign company level, no reporting to RBI.
Right.
But at the time of exercise, so when the exercise is happening, then the money is sent by the employee, the strike price to the foreign company under the OPI regulations,
Hmm.
right? On a half yearly basis, the Indian company has to report to RBI. There is a form called OPI form. How many employees exercise the shares?
Hmm.
The Indian company will do the reporting to RBI on a half yearly basis. There is a form called OPI form. The
Okay.
employee need not do anything.
So in the second question, where the foreign company grants ESOP to the Indian employees, so in case if the shares are sold or you receive dividend, what is the process? Means if they are there any repatriation requirements applicable
No,
to
no, see,
this
dividend is not
proceeds
paid
of
on
this?
the options. Okay, dividend is paid on the shares.
No, no.
So
Once the shares
after they
has
have
been issued.
exercised,
Hmm.
they are like any shareholder, any individual in India holding shares of a foreign company under the OPI regulations.
Right.
So under the OPI regulations, whenever you get any dividend, the AD will ask you for the purpose of the money which is coming and hitting your account. That time you will say, these are my shares which I got. So that
Right.
time he will ask to get you the reporting which the Indian company has done, which they were supposed to do when you exercise the shares. If that is done, they will give you the credit. If that is not done, they will say get the reporting done, they'll like give you the credit. It applies to both, whether any dividend or if you sell the shares tomorrow, when you get the money into India, all this will be checked by RBI because before giving credit, the AD will ask you the reporting, right? So all those have to
Right.
be there with the employee. Otherwise, the credit will not be given.
Right. Understood, sir. So we'll move to the next question. This is related to downstream investment. So the downstream investment is an investment where an foreign investment has come to a company and the same investment has been invested by the Indian company in another company, right? So in this case, uh, um, a foreign investor makes an investment in an Indian company, and Indian company reports the transaction by the filing form FCGPR. Subsequently, this Indian company makes a downstream investment into another Indian company and files form DI for the same. The second company further makes a downstream investment in the third Indian company using the same funds. The question is the second company is required to separately report the downstream investment in the third company by filing a Form BI, even though the funds has already been reported as a downstream investment at the first level?
See, if you see the downstream investment concept, it is nothing but a concept which is basically framed to make sure that things which cannot be done directly should not be done indirectly. That is the what do you call the regulators' view. Hence, the downstream investment regulations were framed. So we need to basically understand what exactly is a downstream investment before I specifically answer your question. So under the downstream investment regulations, there are two. There is one important aspect. One is when do you do a investment, whether that qualify as a downstream investment. So if there is a company which got foreign investment from a foreign company, okay, and that A company in India is investing in a B company in India. So prior to 2011-12, there was no reporting required for the downstream level. It was all at the initial level. Post that, whatever you wanted to do, you can do. So people used to basically, for example, now in India, agriculture is completely prohibited. Any company which is in an agriculture business cannot accept a single rupee of non foreign investment, right? So people used to do different kind of structures. They used to have one holding company. Below holding company, they used to have entities which were doing prohibited business, and they used to get money from abroad in the ultimate holding company, which is in India, which was doing say some business, which was doing say some business which is allowed under FDI regulations. Say IT company, but below IT company they were doing agriculture business. So ultimately, what is happening? The IT company is qualified to take FDI. They were taking FDI, and the entire money was going into the agriculture business, which was prohibited. So to basically make sure that the structures are not misused, RBI came out with the downstream investment regulations. They said if you are a foreign owned and controlled company, so they have given what is foreign owned and what is foreign controlled. So at a high level, foreign owned means any investor who is owning more than 50%. Any foreign investor is holding more than 50%
in
in
Indian company.
Indian company, then that becomes a foreign owned company.
FOCC.
FOCC. For again, foreign owned and controlled company. Now, control, there are different aspects, not only because of shareholding, but there are different rights, which I don't want to get into now. But as a thumb rule, if a company which has more than 50% of non-resident investors, that becomes a foreign owned and controlled company. The moment you are a foreign owned and controlled company, if you are doing a downstream investment, then you have to file a DI form. And you have to ensure that whatever was applicable at the first level. And important aspect is sectorial cap. So in the first level, you were IT company, you were compliant with FDI regulations, you are allowed to take 100%, you have taken, fine, absolutely fine. At the downstream level, you also have to ensure that the sector which these companies are operating is compliant with the FDI. So to answer your question, at all levels, this has to be seen. So at second level, if second level company is also a foreign owned and controlled company. I don't want to get into mathematical calculation, but there are calculations given when you will be a foreign owned and controlled companies at all levels. The moment you are a foreign owned and controlled company at any level, whether 5, 6, 10th level, you have to file Form DI. So the thumb rule is check the definition of FOCC, compute direct foreign investment, indirect foreign investment. If it is more than 50%, then you have to do EDI filings at all levels.
And it should not be a prohibited business.
All FEMA pricing guidelines will not apply.
Right.
Your sector should be seen. Your reporting has to be done. And there are other conditions also. If you are a foreign owned and controlled company, one of the important condition is if you are a foreign owned and controlled company, if you want to acquire a company, generally what happens is we have seen in the market that people borrow money from domestic market and acquire Indian company. So if you are a FOCC, you are not supposed to leverage from Indian market and acquire a company. Those kind of restrictions are also there. So the moment you become FOCC, there are different set of rules.
Understood. So we have completed the question. So we can take up the Q&A.
Sure.
Okay, yeah. So anybody want to ask the question, they can unmute themselves and ask the question. Meanwhile, there is one question in chat from Ravi. One question on ESOP. If a resident Indian was allotted shares of a foreign company, who shall be filing annual performance report? Will your answer change if such resident Indian got listed shares on a foreign stock exchange?
No. See, what is the question? The resident,
Resident Indian was allotted shares of a foreign company. Who shall be filing APS? Who shall be
So
filing APS
see, if
report?
there are multiple residents, for example, there are 5 people who are holding shares of a Indian company, of a foreign company. One of them has to file.
Right.
As long as one of them files, fine. If any of them has not filed, then it becomes a violation.
So
But
the question has little clarification. This is very specific to IBM, where some of the resident Indians were on the rolls of foreign IBM company. They got stocks, IBM listed stocks. So they say we don't comply any annual or biannual compliances. Whereas in case this is ideally a case of a ODI where you have to file annual performance report. So they say we don't file it. So who will be filing it in this kind of situation?
no, did they get the shares through
They got through ESOP.
ESOP? Na? So I answered, right. So if they have got these shares through ESOP, at the time of excising the shares, there is an OPI form which the company has to file bi-monthly, 6 months. Within every 6 months, whoever is the employee was excise shares. I'm assuming these employees are Indian company employees, but got shares of a foreign
Stores of
company.
foreign company, right?
So every 6 months, there is a OPI form which the Indian company has to file for all the shares which have been excised by their employees for the foreign shares, which they have got allotted through the ESOP scheme. So that 6 months bi-monthly reporting is done under the OPI form, but the obligation to file it is with the Indian company.
Indian company. Okay.
Yeah.
Okay. Done.
I have one question. This is with respect to trade payables. If there is one case also going on from Google India, where the company has to pay the trade payables are been pending for last 4 months. Sorry, 4 years. So and ED has came and they have issued a notice that this will fall under ECB. So
See,
what's your take on that, sir?
ED has vast power. Okay.
Right.
So generally, what will ED do? So ED wants to basically challenge a transaction which is structured in a way which is not that way. It's a different color which you have given. For
Right.
example, I I got a lot of money through exports,
Right.
but I have neither exported the money, I have neither exported the goods or services, neither I have refunded the money.
Hmm.
3 years, 4 years, ED will call
Hmm.
you. They'll ask you,
Right.
was somebody has sent you money, you have
Hmm.
not given him the services, you have not given him the goods,
Hmm.
neither he has sent you any legal notice. What is happening? What does it mean?
Hmm.
So
Hmm.
they will try to basically say that this is nothing but Hawala transaction. Your
Right.
money has gone outside India and it has
Hmm.
come into India.
Hmm.
Right? So ED has vast powers. Now, the question which you are asking, whether ED assumes that just because a transaction has been structured as a trade payable,
Right.
but that is not the color of the transaction. The color of the transaction is like an ECB.
Okay.
So they have that kind of powers. So if it is not fitting into the substance of the transaction, they can question and you have to prove. Because
Hmm.
if it's an ECB, if it's a trade payable,
Hmm.
then why you have not paid?
Right.
Why the other side is not taking any action?
Hmm.
So if in your example, for example, a
Hmm.
holding company wants to give an ECB loan to the Indian subsidiary,
Indian subsidiary.
they have to follow a bunch of rules, right? The all-in cost selling cannot be done more than a specific purpose, and there are certain end-use restrictions. The money cannot be used for working capital,
Hmm.
capex. If I'm
Hmm.
a holdco, I will ring fence the transaction by saying that okay, I will
Hmm.
do certain things which ultimately will give you cash flows, and
Hmm.
it will not come under ECB regulations. So ED questioning a transaction, I think specifically depends upon the nature of the transaction and what exactly are the facts of the case. But they have the powers to do it.
Right. Right.
And they'll only do it when they are not able to basically find the substance of a transaction.
So one more question is there. This is with respect to all-in cost. An Indian company pays 3% guarantee commission to a foreign parent for providing ECB guarantee. Is this guarantee fee included in all-in cost ceiling?
Yeah, guarantee fee is included in the all-in cost of ceiling. So whatever is the all-in cost ceiling, LIBOR plus whatever 500 basis point. So whatever guarantee fee you are paying has to be within the range of the all-in cost ceiling.
I think we are done with the questions. Anybody have any questions? You can raise the hand. And
But there are questions in the chat box also, right?
or the chat box which we are posting, that what we are discussing now.
So there are, acha,
Uh,
so I don't know. So there
yeah,
are 11, 12 questions. So these are all answered.
Yeah, yeah.
These are the questions which we are discussing. So our
Okay.
team is posting it. Ma'am, anything you want to add?
No. So I think,
Yeah. Yes.
I mean, good discussion, good point.
Mm.
So if most important thing in FEMA, or 3, 4 things which have to be really remembered is uh, what we have seen, many cases that have come in, is that many foreign shareholders or even NRIs are not, equipped, or they do not understand the FEMA guidelines over here. So they generally, since for them, money or, any foreign exchange between any countries is free flow. I mean, they just send transactions from one, bank to another bank without much consideration. And sometimes they follow the same through even when it comes to sending money into India. So what is important is that all of you have to ensure that make your clients aware that if there is any foreign transaction, money can come in only in 3 to 4 forms. Also, what we have seen is, I mean, only 3 forms. One is obviously either as a capital, as an ECB, or through invoicing, right? So that's the only way money can come into India. Uh, but we've seen many a times that some, especially when it comes to foreign holding company, holdco company setting up back offices in India, before they can even set up the office, the foreign company acquires assets for the Indian company through the foreign company itself, and then they want those company to then put that as equity. I mean, obviously we cannot put that as equity into India because this has directly been paid by them, and there's no way. Second is that even if they have paid it directly to the vendors, so it's not even come into India, but they have directly paid to the vendors, then what is the solution for this is what they ask. Prashant, do you have an answer for this?
Generally, also, I think after the transaction only, the directors come that the transaction has been done. Now we have to figure it.
Yeah.
What was the exact question?
So question is that the foreign company, that is the holdco company, they have directly paid the invoices for the assets acquired by the Indian company to the vendors without
Okay.
bringing it into the Indian company's account, because there was no account open then. So they directly have paid. Now they want the assets to be, and this particular whatever inflow they have brought to be brought in and showed as capital in the
You
Indian company.
see, that typically means that you have to create a liability in your books,
Correct.
right? And then that liability you are going to capitalize.
Correct.
So you have to make a specific application to RBI through the authorized dealer, giving them the details. But there, the foreign company is directly paid for our assets. That's what you're saying, right?
Correct. To the vendor.
So as long as we are able to genuinely, but the problem here is bill of entry and all has to come. So those bill of entries should be there that the asset has come to India. That's important.
The
Uh,
asset was acquired from India only.
Acha, from India. Okay, fine. So as long as we are able to prove that there was a liable, there was a payment from by the foreign company, along with all the proofs, then you have to make an application to RBI. As long as we are able to prove the genuinity of the transaction, then RBI will allow. But it will take time because generally what happens is these kind of transactions, they will want to get into the depth of it because they
Yeah,
will.
but then in that case, since there is no FCGPR being filed, then, right?
No, it has to be filed now. Shares are being issued now, right?
Right. So that's what.
So you can't issue shares until RBI gives you the approval.
Hmm.
So first you have to go to RBI, make an application, take permission for issuing shares, and show them the liability as genuine. Take approval and then do it. Because under FDI regulations, you can see there's a para which says that you can capitalize the liability subject to RBI's approval. So you
Right.
can go under that.
Okay.
Okay, ma'am. Then I think we can conclude the session now. Sir,
Yes.
thank you very much, Prashant sir, Rashida madam. So
Thank you.
it went very well. I think lots of insights with respect to FEMA. And thank you once again.
Thank you,
Thank
Sandeep. Thanks,
you.
madam.
Thank
Thank
you.
you.
Thank you.